Welcome back to Optimal Coverage, and today we're going to cover how much life insurance do I actually need? Because everybody's going to need a different amount of insurance, right? This is going to depend on your age, where you are in life, how many dependents you have, and what assets you're sitting on that you want to protect from the government and the IRS. And this is why most people start with the DIME method, D-I-M-E, debt, income, mortgage, education. If I could restructure it, it would be DIML because I would add an L for legacy, but that's just me. So the first one is debt. Most Americans are in some type of debt, whether it's medical debt, student loan debt, business loans, cars, mortgage, whatever it might be. And you definitely don't want to forget about those co-signers on your student loan debt because those never go away. They will go after your co-signers. And I've had clients that have been affected in retirement for student loan debt. So get a hold of that. So we want to make sure that those debts are covered. That way it's not landing on somebody else. God forbid something were to happen to us. The next is our income. The rule of thumb is you want to times your annual income by 10 to 15. So if you make $100,000 a year, most people are getting $1 million or 1.5 million because this at minimum is what your family would need, your dependents would need if something were to happen to you, your spouse, your kids, your business partner, etc. But really when you think about your family, this would give them 10 to 15 years to get on their feet, for your spouse to find a better job, go back to work, or maybe the economy is not that great, or maybe grandma and grandpa aren't available to babysit. So all these expenses just start to really pile up if you were to leave this on your spouse or your family. This would ensure that the kids are safe and are covered until they are adults, at least somewhat independent. And this would make sure that they don't go backwards in life, especially in today's economy with all the uncertainties. The next one is mortgage. This should really be included in debt, but because mortgages are so big on their own, it gets its own letter. I mean, the average cost of a home today in 2025 in the US is $400,000. That's the average. Could be less, could be more, but in places like California, like where I'm at, New York, the average is $800,000 depending on where you live, which is absolutely insane. You probably don't even have a backyard. And that debt is yours for the next 20 to 30 years. And it's your most important asset. Your family needs somewhere to live. The kids need somewhere to grow up. You have to come home every day. Some people have businesses running out of their homes. So this is a very important asset to protect. And I'm telling you right now that private mortgage insurance does not protect you. It protects the bank, and the bank does not care if something happens to you or you get sick. So you should probably also throw that on your life insurance tab when we're looking at how much life insurance do we need. The last thing our spouse wants to hear is, well, if something happens to me, just sell the house. Yeah, let me just pack up and sell the house while, God forbid, something happens to you, and hope that it's a good economy to sell a home in. Next, E is for education. And this one is very important for a lot of my clients because they realize if something happened to them, their kid is eventually going to have to go to some type of college or trade school or something to really compete in the market in the future, especially with AI and all the competition with jobs today. And if you look around, at minimum, a trade school can be between $50,000 and $100,000. In universities, oh my gosh. I have a client who's paying up to $200,000 by the time his kid is done with college. So that's a hefty price. You want to make sure that money is included for the future of your child's education. Now, let's be honest. This is why most people in their 20s are not getting married or buying homes, because they're going to have to choose. Do I want to get married and spend $50,000 on a wedding? Do I want to put down on a home? Or do I want to go to college, get myself educated, get a great job, and then take care of myself? So that is our job, to make sure that we leave that cushion for them. And last is my L, stands for legacy. Not only am I going to make sure that my kids have enough money for a cool car, to put down on a home, some seed money for a business, but I want to make sure that if I'm not here for some reason in the next 10, 15 years, 5 years, whatever it is, that they have everything that they need. They can go on Disneyland trips. I'm going to send them to Hawaii. I have extra cushion built into my life insurance just for those things. But one of the main things that I see missing from all of these websites and other people's YouTube channels is that a lot of people aren't factoring your age for some reason. Maybe we should throw A in there as well somewhere. But age is going to play a huge factor in how much life insurance you need, because certain ages are going to have different factors and different needs. People in their 30s, starting a home, having a few kids, People in their 40s might be starting those businesses or, taking on bigger adventures now that they're doing better in life, buying a second home, whatever it might be, having another child or adopting. And then in your 50s and 60s, people are headed towards retirement. The issue today is medical debt is eating at people's retirement. Heart attack, stroke, cancer. That's why life insurance policies have living benefits included in them now, if you choose the right company, because you have cash on hand. If, God forbid, you were to have cancer, heart attack, stroke, become disabled, organ transplant, coma, whatever it might be. But I do notice that more and more seniors, or people just over the age of 50, they are getting pretty big policies, whether they're doing, it used to be a small burial insurance policy, 30, 40,000 for burial needs so that bill doesn't land on somebody. But I have people in their 50s, 60s that are getting 10, 15, 20-year terms for a couple $100,000, maybe like a return of premium option or something. They're going to pay more for that so that they get all their money back if they don't use it. But everything's always changing. So I don't see a lot of people taking into consideration that age is also going to play a huge factor in all that. But at the end of the day, everybody's going to have a different situation, and a lot of feelings are involved when you're thinking about, if I was gone tomorrow or next year, how much coverage do we really need? We got to sit down and talk about this. Who's our backup beneficiary if, God forbid, mom and dad go together? Who's going to watch our kids? Do the courts decide? So a lot of feelings in this as well. So you want to make sure that you're looking at everything and really considering, worst case scenarios, best case scenarios. But I know this was a lot. So if you do have any questions, please reach out down below. If you see the more button here on YouTube in the description, I have a link where you can go get some quotes, see what all the carriers are offering, or you can book a call and we can just have a quick conversation, get you some quotes right over the phone if that's better, so that we can protect what matters. I'll see you guys on the next one.